Welcome everyone back again. Another Financial 15, the show where Kevin and I try to provide some financial knowledge, something to improve your situation. We do all that in 15 minutes or less. Today we're talking about lifetime capital gains exemption. What is it? How can it save you tax? We're going to get into all those details, so you definitely want to stick around.
Yes, this is definitely one of the more important topics that we've talked about, always dealing with saving with tax. Everybody wants to know they don't have to pay the government a lot of money. But if you want to find this video or anything else we've done on that or any of our other series, please go to our YouTube channel and subscribe. Lots of great content, lots of stuff to see, and a lot of different videos to view, or like us on Facebook. And most importantly, visit us at our website at beckerorr.com. Great content there, blogs, the whole 9 yards. Webinars, you can find it all. But today we are dealing specifically with the lifetime capital gains exemption and how we can save tax on that. Clint, I think we have to describe what is this that we're dealing with before letting everybody know. Is it individual, corporate? How's it work?
Yeah, there are some details here, and that's the whole point of today's video is going through that. What is the lifetime capital gains exemption? Well, an eligible individual is entitled, fancy definition here, but essentially the idea is you're entitled to cumulative lifetime capital gains exemption on the net realized gains of any disposed qualified small business corporation. So a lot of jargon there, intentionally underlined eligible and qualified. We'll get into that in a moment. But the central idea here, Kevin, you start a private company, you incorporated, you sell the shares of that company, you can get a big exemption and save a whole bunch of tax. That's really what it comes down to.
Nice.
And the exemption for 2022, you can see it in blue, $913,630. That's a big number. And that works out to a capital gain of about $456,815. You're trying to think to yourself, well, how much tax am I actually saving here? Well, depends on the province you live in, but you're probably going to be in that $250,000 if you're able to use this. So if you sell a company and you're able to get $250,000 tax-free, that's a pretty good deal in my mind, Kevin.
Yeah, that's huge. I don't think that you can go wrong by doing any of that sort of scenario.
Exactly. Now, some of the details. We know there's a big tax savings there, but it's a lifetime amount. What does that mean?
Yeah, lifetime cumulative amount means, basically it's sort of a one-time shot that you're really dealing with on this. I mean, if you're selling the company, then you're going to be able to claim it all and get up to that scenario. So, I mean, theoretically, that's the most. I mean, if you have $1.5 million for it, as we've said, 913 will count towards that. You'd have to pay taxes on the rest of it beforehand. But again, this is sort of a cumulative account. So you're not doing it multiple small amounts of times. It's usually a one-time event. Now, if you don't use the full amount, and something comes down the road, you will be able to deal with something along those lines again. But as we say, this is traditionally not the way it works otherwise, but it is allowed there, fully cumulative over your lifetime scenario.
Yeah, so if you build up a company and you sell it and you use the full amount, you sell a company for $1 million, you use the full 913 that's available for the exemption, then you go build a second company, well, you're not getting the exemption in company number 2. On the first company, if you sell it for $500,000, well, you got 913 years, so you can use 500. The rest can carry over, and then if you do a second company, maybe you can use it on that one. And key here, Kevin, is we're talking about corporations, but corporations have shares. The shares have to be owned individually. It's per individual here, the exemption. So if you have a company and that company has shares owned by another company, well, that could mess up your exemption. It's meant to be per individual. Also, that means if I own shares, my wife owns shares, maybe I have adult kids that own shares, everyone might be able to get the exemption. That gets a little more complicated. You got to plan for it, talk to the accountant about that, but that is certainly possible, and some folks plan to do exactly that. So they have family-owned shares, and then they can get multiple exemptions when they eventually sell the company. But the key there, per individual, so not corporately owned, you own the shares of your corporation. And then key here, Kevin, is you're selling the actual corporation, right?
Yeah, and that's the big factor. We're not selling, so something privately, or we don't have different shares that are preferred. These are the corporate shares that you own in the company. These are the ones that have to be solved so that you can get that lifetime capital gains exemption. And as Clint's mentioned many times, the biggest way to go about knowing whether you qualify or whether you don't, make sure you consult with your accountants on these things, because they are the ones that are going to have the in-depth knowledge of what's going to go on and what isn't. But a corporate share scenario is exactly how it has to be. It can't just be, sort of single entity. If it's a non-incorporated company, you do not get the lifetime capital gain exemption. That's the biggest factor. It has to be incorporated. The shares have to be corporate shares, and they have to be individually owned to be able to get this sort of an exemption going forward.
Yeah. And when it comes to the sale, the buyer has to be buying those shares. The buyer can't be buying the assets. So if you have a corporate entity and you own real estate as part of your business, and they buy the real estate, you're not going to get the exemption. They have to buy the shares. They have to buy the company and everything inside that company. If they go buy any of the assets, you're not going to qualify. So corporate shares, they actually have to buy the corporation. in order to get the lifetime capital gains exemption. So I mentioned earlier, we had that fancy definition. We underlined eligible and qualified. We now have to kind of explain really what did that mean. In the first one here, Kevin, eligible, they have a fancy definition. This is taken directly from the government website, canada.ca. Essentially, it boils down to resident of Canada. The underlined bit that kind of qualifies the eligible piece. And they have details here about how long you have to be in Canada, how long you have to be a resident. But essentially, resident of Canada, that's the goal here. This is meant for Canadians, this exemption. So if you're not a Canadian and you own a corporation, you sell it, you probably won't qualify. The eligibility piece has to be an individual resident of Canada. The qualified component, though, Kevin, that gets a little more complicated. There's a few steps here.
Yeah, I mean, when you qualify for the small business, step number one is that, throughout the 24 months immediately preceding the disposition of the shares, they have to be owned by you or a person or partnership that you're related to. So you or your wife or kids or something that you've structured that way. And the big important part to remember about this is that 50% of the fair market value of the assets were used in the active business carried on primarily in this country. So by active business or active management, or should I say active assets of the company, what we're talking about is they were involved in the business. As Clint just mentioned, it can't be real estate that you've owned that's just sitting there. That's not actively in the business. If it's pieces like that, that does not qualify. So you have to have at least 50% in the business that is actively assets of the corporation. That's an important point to make sure. At least 24 months immediately preceding the disposition of these shares.
Yeah, so a couple of steps. First step is that 2-year period you just talked about. So 2 years before you sell it. So important there. They're thinking, 2 years before I sell it. Obviously, you have to plan for this then. Spontaneously might not happen. So 2 years before you sell it has to be part of the ongoing active operation. So if your company is, say, car washes, and then you've got additional real estate you're renting out to your friend, and somehow that's in the corporation, well, that's not active for the business.
No.
That's completely separate, and that's not going to count towards the 50% threshold here that must be met. So often you might hear about people purifying a corporation or cleaning a corporation. That's what they do. They take those kind of items out to make sure whether the assets that are actually in the corporation are the ones directly related to the business. Part of the reason they do that is so they can qualify for all the tax savings that come with the lifetime capital gains exemption. And we have the two tests. Kevin just talked about the one 2 years prior. That's step one. And then there's going to be a stricter threshold at the time of the sale. So you got that 2-year window before where it's got to be a 50% threshold. And then at the time of the sale, it's 90%. So really, you can't have much that's not directly related to the ongoing business at the point of sale. Otherwise, you won't qualify for the exemption. You won't get all the tax savings. Another point there on both criteria, I mentioned primarily in Canada. So you can have a little bit of outside business. It doesn't have to be solely within Canada, but like you said, not a lot. It has to be meant here for Canadian business, private companies, Canadian individuals, saving some tax if they meet these criteria. I mean, lots of tax here, Kevin, but there's also a couple of steps, right? So people got to plan for this.
Yeah, exactly. I mean, and that's the biggest factor I think you have to realize is that it's not an overnight scenario. Somebody's not coming up to you tomorrow and say, okay, I want to buy all this, and you haven't planned for it. You have to make sure that if you are going to look at this and you're going to realize the lifetime capital gains, you have to plan for it. As we've mentioned, it starts on step one is 24 months ahead of time. You need to have at least 50% of the business active management, right? Active assets that are in the corporation. And at the time of disposition, 90%. So, I mean, the last thing you want to do is know that you're at 50% and you want to sell the business a week from now. Guess what? That's not qualifying inside of these lifetime capital gains exemptions. So you're not going to get it. You have to make sure that you're planning it. And again, dealing with part of that planning process, talk to your financial advisor, but also make sure that you're dealing with an accountant on this. They know the rules backwards and forwards. They're going to help you through the process to make sure that you're getting that lifetime capital gain. And as Clint mentioned, I don't know for most people, but if you can save up to $250,000 worth of taxes, that sounds like a fairly reasonable amount of money that's going to go back in your pocket as opposed to spending it in the government's pocket.
And that can make a huge difference for a financial plan. Often business owners that build up a company, the company can be a big part of their retirement, right? Selling the company, passing it on to the next generation. So making sure that's tax efficient could have a big impact on the overall retirement. So absolutely you want to make sure it's planned correctly. And like you said, this is very accounting heavy. Your accountant's going to have to go through all the details, making sure your corporation meets the test we just talked about. So absolutely talk to the accountant, talk to your financial advisor, plan in advance so that you can save all of these tax dollars. And if you have more questions, where should people go, Kevin?
People should visit chatwithclintonandkevin.com. We are more than happy to answer the questions you do have on lifetime capital gains exemption or any other financial planning aspects that you're dealing with, how your investments are, if we need to deal with things on taxes and where to go that way, wills, estates, the whole 9 yards. But again, anything that comes up, please contact us. We're more than happy to help you out with it. And today we've covered the lifetime capital gains exemption on a high level scenario. If you want more in-depth, let us know and we will personally help out with what we can.
That sounds good. We'll see you again soon in another video. Take care.